Welcome guys. In this video, I'll be explaining to you what leverage is in Forex trading. So first things first, what is leverage? Leverage is borrowed funds provided to us traders by a broker. We have leverage of 1:50, 1:100, 1:200, 1:500. And some brokers offer leverage of up to 1:2000. Now, where do you find this leverage? You will find it when you are registering a broker account. There you will be asked to select your preferred leverage. I promise you, by the end of this video, you'll be able to determine the leverage to select for your trading accounts. Now you may be wondering, how exactly do Forex trading using leverage work? Let me give you an illustration of the whole process. I want you to think of your broker as a bank who fronts you an amount of money, let's say 100,000 US dollars, to buy currencies. But all the bank asks from you is that you give it a certain amount. In this illustration, the amount is $1,000. Now, this money the bank asks from you is seen as a good faith deposit, which we hold for you. So, whenever you make this small deposit into your brokerage account, the broker gives you access to trade huge amounts of money. Hope you're understanding this. Another question now is, how do you know the amount of borrowed funds your broker will give to you? From selecting any of these leverage levels. Okay. Now the leverage 1:50. Let me get my text here. The leverage 1:50 means that for every $1, your fund into your brokerage account is viewed as 50 USD. Do you understand? Same goes for leverage 1:100. Every $1 in fund is viewed as $100. So basically, it's your deposits. It's your deposits times the leverage you selected. Now I'll give you your borrowed funds. Okay. Let's use the leverage 1:100 for our example. And assuming that you made a deposit of $1,000. Deposits $1,000. Now, how much borrowed funds will you have access to? To know this, we multiply your deposits. Multiply your deposits by the leverage. In this example, that will be 1,000 times 100. That's going to give us $100,000. Okay. So using a leverage of 1:100 with a deposit of $1,000 gives you access to $100,000. But I want you to note that this borrowed money, this $100,000 now that your broker has given you access to, won't be displayed in your account balance. What will be displayed in your account balance is this $1,000 you funded. But on the back end, you can buy currency pair of up to $100,000. I hope this is clear. Now let's see how leverage really helps us in our trades. Okay. Still using the leverage and deposit amount from this our example. So let's say, for example, you want to buy GBP USD. To buy GBP USD. With this account we just created now, this is our account here. So we just created our funded $1,000. We want to buy GBP USD with it. Okay. And for the trade, we want to make use of the mini lots. Remember what I said in my video about lot size is that mini lot starts from 0.1. And that using a mini lot means you want to buy 10,000 units. Of the currency pair you want to trade. And for this example, we want to buy GBP USD. So that means we want to buy 10,000 units of British pounds against the US dollar. 10,000 units of British pounds against the US dollars. So next we'll calculate the amount of money you need to buy that 10,000 units. And to do so, we need the price quote of GBP USD as at when you want to buy it. Okay. Now for this our example, let's assume that you want to buy GU at, let's say 1.27000. That's the current price quote for GU. Okay. So to get the exact amount of money you need to buy GU at this price would be 10,000 units times the price quote. That's 10,000 units times the price quote, and the price quote is 1.27000. That would be, let me bring out the calculator for this. 10,000 units times 1.27000. That would be 12,700. What this means is that without leverage, as if leverage didn't exist, you would need 12,700 US dollars to buy just 10,000 units of British pounds against the dollar. Now, remember, you only have $1,000. You only have $1,000 in your account. So what happens now is that your broker will automatically deduct 1% of this $12,700 from your deposits. Now, 1% of this amount is $127. $1 of 12,700 is $127. Okay. Now, after they deduct this 1% from the $12,700, the remaining balance that you need to open this trade, the broker will not provide it for you. I hope you understand. So this 1% they deduct from your balance will be locked as your margin. This 1% now is your margin. They will lock this 1% as your margin. Don't worry, guys. In my next video, I will explain more about margin. Okay. So from this example now, you can see that your broker provides you with 99% of the money you need to open a trade. Do you understand why I said 99%? Because they only deduct 1% from the amount you would need if there was nothing like leverage before in the forex market. From our example, if you minus the 1%, that is, well, let me clear the calculator first. If you minus the 1% from this 12,700, that will be 12,700 minus 127, $127, that's the 1%. We get $12,573. 12,700 minus the 1%, that's 127. We get 12,573 for every mini lot trade you open in this account now. This is the amount your broker is going to provide you with. This 12,573. Then the remaining 1% to fill up the amount of the money, they will deduct it from your deposits. And they will lock that amount, that 1% now that they collected from deposit, they will lock it as your margin. Okay. So let's move on. It's important to know why the brokers came up with leverage. I'm sure by now you already know the answer. But in case you don't know, brokers came up with leverage to help small investors like yourself trade large amounts of money, to be able to buy more volume, more than your money can carry. Moreover, for these leverage services the broker are giving to you, they charge you in form of spread. They charge in form of spread, and in some brokers, they charge in form of commission. You understand? So the final question is, how do you determine the leverage to select for your trading accounts? Now, to determine the right leverage for your trading account, you must consider these 3 key factors. One is your risk tolerance. The risk tolerance. You need to assess your comfort level with potential losses, because the higher your leverage, the higher the profit you make, and also the losses. So you need to work on your risk tolerance first before you can decide on the leverage size to use. The second key factor is your trading experience. Your trading experience. How long have you been in the forex markets? So if you're a beginner, it's advisable to start with lower leverage until you become more familiar with the trading dynamics. Okay. So the third factor is your trading strategy. And there are different trading strategies, and these various strategies may require different leverage levels. Like for scalpers might use higher leverage for quick and spot trades, while long-term traders, such as the swing traders or position traders, they often use lower leverage. Okay, so by considering these factors, you can select the leverage that best fits your trading style and risk management approach. This brings us to the end of this video. I hope you found it helpful. Do not forget to hit the like button and subscribe to my YouTube channel for more content like this. See you in my next video.